Measurement. Ooh. So with measurement, and this is why I wanted to go through the CDO stuff and the CDO and repo stuff before we did this. Because what we want to look at today, and just in the spotlight for today and the company we're looking at, is a company called Bear Stearns, which some of you may have heard of, may not have heard of, no idea. It sort of disappeared about 2008, so 5 years ago, which, I'm trying to remember what I was doing 5 years. It was a while ago. It was an investment bank anyway. So it was a former investment bank. It was purchased by JP Morgan Chase for $2 a share in March 2008. The previous 52-week trading high it had was over $133. So in the space of a year, it has just absolutely gone down the toilet. Now, it held, literally not long before it collapsed, it had over $400 billion worth of assets. And of that, around about 45% were securities. So you're talking sort of equity instruments, whether it be sort of more complex instruments, but a lot of it was, were securities. It had only $11 billion in equity. So if you think about the leveraging that's going on there, it's substantial. And I think that's about 35 to 1. So if you have, if you have a 2% movement in assets and that all comes through profit and loss, like you wipe out, like you have a 3% movement, equity's gone. Like you then are there is no equity left in the business. Obviously, if things are going well and things are going up, you're massively leveraging the upside. Unfortunately, there is also a downside. Now, one of the issues, like they had a whole bunch of issues. Now, one of the issues that they had was they were quite heavily into CDOs. They had a lot of CDOs sitting there, and they were, they had not just through them, but through various vehicles they had. They also used repurchase agreements quite heavily. Around about 25%, 26% of their assets were in effect funded by, in essence, overnight borrowing. And that's fine. So I go to Anthony, I'll use these as collateral. Will you lend to me overnight? Will you lend to me for tomorrow? Fine, that's good. You'll take a small, you'll pay interest for it. That's good. I trust you. The next day, will you lend to me? That's fine. And that just keeps rolling over while things are going well. The problem that they had was, as CDOs, as the market started falling out in the credit side of things, as mortgages started going down, as property prices started falling, those income streams in terms of the CDO started to dry up a bit, and everyone started getting worried about, are these things actually worth anything? And at whatever point in time, Anthony and everyone else that was lending to me just went, hang on, I'm not really comfortable where you're at right now. I am not going to keep this cycling through. I actually just want my cash back. Now, if you've got close to $100 billion in overnight stuff, and if you have to pay that within 24 hours, that's not an easy thing to do. It's not like you can suddenly sell all your property in 24 hours, get it done, get the cash in and repay it. Like that cannot happen. So that means a lot of the liquid stuff, that starts getting sold. If you start dumping large amounts of equities or large amounts of securities into a market, what do you think is going to happen to the prices of those? Yeah, they drop. And that's, as soon as that starts to happen, if they'd gone completely under, and Bear Stearns was saved by the US Fed, like they actually didn't let it go under. For some reason they let Lehman go under, but they didn't let Bear Stearns go under. If they'd gone under, all of their securities, they get pushed out into the market because they've got to liquidate them all. That happens. That pushes all those prices of all their various things down. So say, for example, they hold a 10% stake in BHP, just for argument's sake. They drop all those into the market. BHP shares drop. That means my holdings of BHP shares are now worth a lot less than they were the previous day. If you're using what's called fair value accounting, mark-to-market accounting, that means I'm marking those down on my books And if I've got agreement set up in place, maybe the people who are lending to me start questioning what I'm doing. Potentially that means I've got to liquidate positions. If I'm starting to drop those into the market, that just keeps everything going down. And that's why the US did step in when it did, because they figured it wasn't just saving this one bank, it was saving the system, because if you let that just unwind, that could just spread everywhere. So, well, at least that's the argument. Now, there is a counter to that argument, which is as soon as you start stepping in and saving banks, people go, hang on, they're stepping in for them, we're too big to fail, as you may have heard that term. We can kind of do whatever we want because we know they're not going to let us go under. So there is a moral hazard that introduces. So there's an issue around fair value accounting, which there was a lot of criticism about the accounting at that point in time, that it allowed these sort of things just to gather steam. I personally don't think that's, I think there are a lot of other things that caused the problem. Maybe it did add on the edges, but I don't think it's the only thing. So, getting into the actual accounting for it now. How we measure a financial instrument, and this is any type of financial asset, financial liability, is we look at its fair value, and then we take into account transaction costs. Now, for what we're doing, we're ignoring transaction costs. We just say, what was its fair value? That's what you put it on the books at initially. Then, how you go forward with that is either using an historic cost method or a fair value method. So it's actually not dissimilar to property, plant, and equipment, where there's a revaluation model and a cost model. Or if you think about intangibles, gets revaluations or cost model. You still get that historic cost idea versus fair value idea. And we're going to look at, the first lecture demonstration actually looks at the difference in the accounting between those two models. The question then is, which way do we go with a particular instrument? And that depends heavily on the business model and what we intend to do with it. So, Anthony has lent me money. Yeah, that was right, you lent me money. Okay, Anthony has lent me money. If Anthony's intention is to sit there and just watch the dollars roll in, that would tend to suggest he should account for it this way, because he intends to sit back and collect the cash flows. If you intend to do something else with it, if you intend to just originate it and then sell it on, then it's probably suggestive that the amortized cost method is not the best way to do it. So it's kind of looking at the intention there to collect the cash flows. You can, if you want, or companies can if they want, if it's relevant, just designate it as fair value. So there's kind of, it's, if you read through that a little bit, it's almost like everything should be going through fair value unless you intend to be sitting there and just collecting the cash flows. And sort of dealing with the cash flows that way. Now, I only want to bring up one of these. We'll have a look at how these come through the accounts as we go through the demonstration. The two parts I just want to talk about are the fair value through profit and loss, is these top two. These are probably the critical ones that we want to have a look at. Fair value through profit and loss, we take any gains or losses on these instruments through profit and loss. Kind of makes sense given that's what the title of the thing is called, but we take it through profit and loss. Unless, and we will look at this, unless it's part of a hedging relationship. And if it's part of a hedging relationship, then we may do something different. And we'll explore that.